Good morning. These are the things that matter most for the U.S. pre-market. Target is telling Wall Street that tariffs and consumers are not one simple story. AI-linked stocks are becoming more selective. Trump has paused new Canada tariffs, and geopolitical risk is still sitting under energy and risk appetite. The central question is simple. Can U.S. equities keep treating AI as the main story if consumer demand, tariff timing, and global risk all demand company-level proof? Start with the consumer and tariff twist. CNBC reported that Target raised its outlook as sales rebounded and a large tariff refund boosted the bottom line. MarketWatch also led with Target's grocery overhaul, helping it win back customers. That matters because the market is not only asking whether tariffs hurt retailers. It is asking which retailers can protect traffic, price perception, and margins when policy changes arrive unevenly. The cleaner side is companies with scale, grocery traffic, supply chain flexibility, and clear value messaging. Target, Walmart, and Costco are the key comparison set. Pressure sits with discretionary retailers, weaker mall traffic, and brands that have to choose between margin protection and price sensitivity. For private investors, the useful filter is not one earnings beat. It is whether traffic, basket size, and gross margin can confirm that the consumer is still selective but not broken. Second, the AI trade is no longer moving as one basket. Yahoo Finance reported that Dow futures fell as SanDisk, Micron, and Credo led AI-linked losses, while MarketWatch highlighted Cerebras's post-IPO bust and the importance of its new chip for a comeback. CNBC also reported Goldman research on where AI is squeezing labor markets. The hidden mechanism is that AI optimism is splitting into proof quality. Chips, memory, networking, labor disruption, and in-demand do not all reward the same stocks on the same day. The likely beneficiaries are NVIDIA, Microsoft, and Alphabet if AI demand keeps turning into cloud use, chips, software, and cash flow. Pressure sits with memory and infrastructure names when expectations outrun order proof, and with companies exposed to AI labor disruption without a clear productivity payoff. The private investor takeaway is to separate AI adoption proof from AI label momentum. A theme can be powerful and still punish the wrong balance sheet. Third, trade risk changed shape before the U.S. Open. MarketWatch reported that Trump held off on new 50% tariffs for Canadian goods. CNBC reported a 3-day pause and a deal announcement with Ottawa. For Wall Street, that is not just political noise. It can move supply chain assumptions for industrials, retailers, car makers, home improvement, and cross-border materials. The cleaner side is North American supply chain relief. General Motors, Ford, Home Depot, and selected industrials can benefit if tariff risk cools. Pressure remains on companies that still face uncertainty around pricing, inventory timing, and supplier contracts. For private investors, the useful question is whether the pause reduces risk premiums or merely delays the next tariff headline. Confirmation would show up in cyclicals, the Canadian dollar, materials, and transport margins. Fourth, geopolitical and rate risk remain the underappreciated restraint. CNBC reported that Iran is weighing attacks on U.S. targets in Europe, while the United Arab Emirates severed trade with Tehran. CNBC also reported that weekly mortgage demand stalled as rates moved higher again. The hidden mechanism is cross-market. Oil, rates, and housing can quietly cap how far a risk rally broadens, even when megacap technology still looks resilient. The cleaner side is defensive cash flow, energy security, and companies with pricing power. Pressure sits with airlines, home builders, small caps, and high financing cost stories if oil or rates rise together. The private investor filter is to watch confirmation across crude, treasury yields, home builders, and transports instead of treating each headline separately. Here is the stock-led watch list. Target, Walmart, and Costco. Is the consumer selective but stable, or is Target the exception? NVIDIA, Micron, and SanDisk. Does AI broaden again, or is the market demanding harder proof from memory and chip infrastructure? General Motors, Ford, and Home Depot. Does the Canada tariff pause lower real supply chain risk? Exxon, Chevron, and United Airlines. Do energy and geopolitical signals pressure margins before the close? Market bias, selective and proof-driven. The setup can stay constructive if AI demand, consumer traffic, and tariff relief confirm together. The mistake to avoid is treating every positive headline as the same kind of signal. A tariff pause, an earnings beat, and an AI story all need different confirmation. That is the U.S. pre-market brief. We will be back tomorrow at the same time with everything that matters. Research context only. This briefing is not investment advice.